So how do we make certain cost decisions when we have concepts like sunk costs, out-of-pocket costs, and opportunity costs? So sometimes we spend money and there's no going back on it. A good example is when I had a recording studio. I had leased out the recording studio and bought a bunch of equipment that I couldn't really resell. It was very customized equipment. Those are sunk costs. I can't get that back, so I shouldn't operate under the assumption that we try to get it back. There's also opportunity costs. Like you could always leave and go into a different marketplace. Or there's out-of-pocket costs, like costs that you have to pay for immediately, or continue to have to pay for a piece of equipment. Like a car, you have to pay your oil changing costs and whatnot. Ultimately, what we're looking at is relevant costs. So what aren't relevant costs? Some costs are irrelevant. If we made a past decision, like let's say you went to the bar last night, you can't get that money back, or you went to a restaurant. Yep. So from a personal perspective, or if you bought something that's not returnable. Let's say you bought like a fancy dress or purse or suit, and it's a custom and you can't return it afterwards. So you can't go back. So it's related to a past decision. We can't change it. For a business, that might be buying an expensive piece of equipment or buying a piece of land, and that's not usable or not sellable. So something that we can't go back and make a future decision on. So it's not relevant. We exclude it from our future decision making. Out-of-pocket costs are costs related to a future outlays of cash associated with a particular decision. So if you buy a car, you still have to pay for its maintenance and oil changes. Opportunity costs are the issue of going into a separate line of business. So instead of buying a car, you could have maybe bought a bicycle. And well, what's the opportunity cost? Car gets you to your place faster. Is that worth the cost? Out-of-pocket difference. So sunk costs are irrelevant. I want you to know that. That's an important takeaway. Opportunity costs and out-of-pocket costs are relevant. We only consider relevant costs. We don't consider the sunk costs. We can't go back. It's really important to get your head around that, where like, if you've done some at a certain point, like a good example is when I had my recording studio. This is the best example for a sunk cost. I continued to work at the recording studio longer than I should have. I knew that its future benefit was paying me an hourly rate. The net income was equivalent to an hourly rate less than a bartender was making. So why would I continue to work in that business if I knew that it would never make more money than I could make somewhere else? Well, I was stuck on the sunk costs. I had spent so much in the business that I wanted to make the money back or see it be more profitable. While my opportunity cost of like going to college or working in a different location or working for someone else. Does that make sense? Like, yes, I had to be like, okay, whatever. I spent the money, I wasted it. I'll try something different. Yeah, you're gonna have to do that a lot in business. So cool. Evaluate make or buy decisions. So these are the type of decisions we're gonna talk about today on where we have to use these relevant costing. So one thing a person always has to decide, you decide in every aspect of your life, you just don't realize it. You can make something or buy it. I'll try to stop so much questions so we can get out of class on time. But an example of making or buying that you make every day is like, how many people here make their own bread? Does anyone here make like their own bread or pancakes or anything like that? Okay, we got some. Most people don't. That's a make or buy decision, right? Like, hey, I like homemade bread actually better, but it's quicker. It's a little more expensive though to buy it, right? Like maybe $2 for a loaf nowadays, but you can make bread for like 10 cents. A loaf of bread with water and flour is very cheap to make. That's a question all businesses have to make. At every step of the way, you could go back in the chain and actually make something. Like, hey, if you are a bread company or a cake company, do you actually want to make the eggs? Should we buy chickens and hatch eggs? Or does it make more sense to buy the eggs? So the question is the incremental cost to making the decision. So the cost to produce an item includes direct materials, direct labor, overhead. We know this stuff. The main takeaway here is when we determine if we should make or buy, we don't use already preconceived overhead. this is like the big takeaway I was trying to take from the last lecture. And this is why it kind of flows into each other is if we already are paying for a factory, the electricity for the factory is already a sunk cost, or the rent for the factory is already a sunk cost. So if we add some more stuff to the factory, it's not going, we shouldn't include it in the decision. We're already paying those costs. So the idea here, we're currently making a part, whatever, let's call it a part. I want to call it a cake. I'm hungry. It's almost lunchtime. So they're making a cake 417 and they're assigning overhead at 100% direct labor costs. So the cake is, with eggs and stuff, is 45 cents. The labor is 50 cents. And then the electricity from the factory is 50 cents. It's 100% of the direct labor rate. The question here is, well, we can buy this cake actually from a different supplier, a different bakery for $1.20. Well, should we make or buy this cake? And so the question is, the making of it costs $1.45. The buying of it costs $1.20. Well, should we make or buy it? Well, we actually should make it because at 20 cents, we're going to pay regardless. The overhead cost of the factory, we're going to have to keep the factory on anyways. So we actually save 5 cents by making it. Does that make sense? I know it's a little counterintuitive. So on the face of it, even though it costs more to buy, it actually, because these overhead costs are sunk, we're paying them anyways. There's no way we can get out of them. Might as well make the cake. Key takeaway here, you take out overhead costs when we're doing make or buy decisions. Does that make sense? Thumbs up, makes sense, thumbs down. We need more. Okay. I'm not going to do the math here because it's really more of a concept, right? So we're going to talk about the next concept. Okay, now we want to put the cake and it's just a raw cake, but now we want to make it icing and like make it all special to be a wedding cake. Let's say the question is, do we make this into a wedding cake or do we just sell like the traditional cake itself? I'll stay out of this because we've talked about so many numbers. I'm sure you're all fried. The concept here is we're just going to compare incremental revenue to incremental costs. So if we're making wedding cakes versus just making flat normal cakes or sponge cakes, if our incremental revenue is greater than our incremental cost, we're going to decide to process it further. If not, then we just sell it as is, right? So the concept here is we always try to sell, make more revenue, like with any business, or make more income. So here we're saying our incremental revenue would be an extra $100,000 to make these new products from the original product. And the incremental cost is only $80,000. So the incremental income here is $70,000. Our decision is yes. And in the quizzes and homework, the question will be like, hey, how much is incremental revenue? How much is incremental income? And then should we process further or not? Yes or no? The question here too is, what if there's overhead related to these the processing? If the overhead is already part of our original warehouse, we don't include it. It's a sunk cost. So the key takeaway is any previously incurred manufacturing costs or overhead are sunk costs. We don't include them in this decision. So they're saying processing costs to date are $30,000. So we're saying we can process as is for $50,000, sell as is for $50,000. That's where this number comes from. Or they can be processed further to produce finished products X, Y, and Z. This will cost an additional $80,000 and will yield revenues of $150,000. So we don't include that original $30,000 in this additional assessment. Those are sunk costs. We already spent it. So we're going to earn an extra $20,000 by processing further. Another traditional business question. Do we scrap a product or do we try to fix it? So like, let's say we made the cake, and one of the bakers messed it up. We could take all the parts of the cake and try to make a new cake, or we could throw it away, right? Those are the two things we could do. You could do that for all products. I'm just thinking about cake. So we have 10,000 defective cakes that cost $1 to make each. We could throw it away now for 40 cents. We just trash it and we have to like pay with our trash cost of 40 cents, or we can rework it for an additional 80 cents. We can maybe add some more butter and whatnot to the cake and spend some more time, and we can make it for 80 cents. If reworked, the unit can be sold for the normal selling price of $1.50. The question is, do we scrap or rework? We always look at what our incremental income will be. If we sell the scrap, so if we sell the crappy cakes or the bad cakes for 40 cents, that's what we can sell it for. We get 40 cents of income. Well, if we rework the cakes, we can sell it for 70 cents of income. So we'll rework the cakes, right? Because we get more income. Keep in mind, right, we're only looking at the incremental income. It already cost us a certain amount to make the cakes in the first place. We're not going to consider that because it's a sunk cost. That's the main takeaway from all of this. Sunk costs are, we don't include them in this decision making. Next question is, what if we are selling cakes and what are some other desserts everybody likes? Bakery kind of items.
Donuts.
Okay, yeah, so cakes, donuts, what else?
Cookies.
Okay, cakes, donuts, and cookies. That sounds like a fun thing. Well, but we only have so much labor and flour and machine capacity. How do we decide what to make? That's the next question. How many cookies versus cakes versus donuts? So we'll stick with cakes and donuts. Those are the first two. We have to determine the contribution margin per unit and per machine hour, and then we'll try to maximize that. And so we're selling these two products, A and B. And we have this selling prices and variable costs. $5 for product A, $7.50 for product B, $3.50 for product A, $5.50 for product B in costs. What we do is then we determine what is our contribution margin per unit. Easy math, that's why I'm not going to go over it again. It's selling price minus variable cost is our contribution margin per unit. And then our constraint here is our machine. So we only have one oven. The cake takes 1 hour to cook. The donuts take 2 hours. So what we do is we figure out our contribution margin per machine hour, because that's our constraint. And then we're going to just make the item that makes the most contribution margin per machine hour. So here we should only produce product A. And so that might be why, like, when you go to bakeries, it's very rare to find it's very hard to find bakeries that make everything, right? There's normally like a donut shop or a cake shop, because they're maximizing their production on one unit. Whatever they get the most profit for. You only can find these very specialized like Asian bakeries and whatnot that do a lot of everything. Does that make sense? So they're just choosing the product that makes them the most per the machine hour. Awesome. So these are just different ways to think about your business models. If you ever want to be a business owner, you can always think about how to maximize your profitability. Take in mind, right? This isn't telling you what's most fun, right? If you want to be a baker and make cakes and donuts, it might be more fun for you to do both, right? But that we're just looking at it from an economic perspective. The last one is evaluate segment elimination decisions. So this is what I was talking about in the last class, was what if we have a department that we want to, that doesn't have a positive operating income. So we're operating at a loss. Should we cut that department? Well, the question is, it depends. We have to look at what the avoidable and unavoidable expenses are, which is generally like overhead, right? We have to look at We can't avoid overhead if it's operating in the same warehouse. So we're looking at these departments, and this treadmill division is operating at a $500 loss. Same as the department beforehand, right? The appliance department from the last chapter. What we'll then do is say what expenses are avoidable. So what does that mean? If I cut this department, how much money will I save? And so they're saying here, we'll save $30,000 in cost of goods sold. We'll cut the wages. So we'll fire the person, the manager responsible. We'll save on all this advertising, insurance expense, all this other stuff. Ultimately, we'll save $41,800. Make sense? And that all will be given to you. Hey, these are all the costs related to the business. But our business operates multiple departments. And some of these costs, like the rent and utilities expense, are going to be there anyways. Like we own the warehouse that operates multiple departments. So we will always have depreciation expense, and we can't sell the equipment. So the equipment, we have to keep the depreciation expense unavoidable. Rent expense, we are going to have insurance related to other products, office expenses, purchasing department, all that fun stuff. We can't get rid of this stuff. So $6,500 of costs is unavoidable. So what we're going to redo is we're going to redo the income statement, add the $6,500 back to the operating income. So actually, by cutting the unprofitable department, we actually lose money, right? Very counterintuitive. So we actually keep the department. Does that make sense? Cool. Any questions? Okay, we'll keep. Oh yeah, Michelle, question? Oh, question, no question. Okay, cool, good, thank you. All these are similar decisions, all using the same framework. So the question is, do we keep or replace a piece of equipment? This is a really common question for cars, especially right now with cars being so expensive. Hey, should I, like I have an old car. I have a 10-year-old car. It has 100,000 miles on it. Should I spend $1,000 getting it repaired and keep getting repaired? Or should I spend $30,000 buying a new car? So you look at your cost to buy a new machine. So let's say this person's buying a $100,000 car, very nice car. Cash received, they're trading in their old car for $25,000. Question is, how much is their variable maintenance costs or manufacturing costs? How much will that change? They're saying here, with buying the new machine and trading in the old machine, they're only going to save $72,000 in maintenance costs over the next foreseeable future. So they shouldn't buy the new machine. It's going to cost them more to buy the new machine. This is just from a cost perspective. Maybe it looks nicer and you want it. Like that's a different thing, but it doesn't make economic sense, right? And that's the truth most of the time, is keeping something older for longer is generally the better decision until a certain point. So that's all like our decision making, all of our like cost decision making. Do we keep, replace? So all your homework and quizzes will have just questions related to, here's a fact set. Do we keep the machine or sell it? Do we sell the division or keep it? And it's always, you look at whatever, we try to take out all the sunk costs and then make the decision. That's really the framework. And these are just some examples of how you do it. Any questions there? Everything makes sense? Thumbs up, happy? We're almost through this. This is the quick one. Next thing is, how do we figure out how to make product selling prices? Oh, chat question, let's see. Good, cool. This is much more complex than what's in here. All right, so I'm just gonna talk quickly about pricing theory. It isn't a pricing class. But we have to think about a lot for pricing. We have to figure out how much profit we make. We have to figure out what the demand of the product is based on the price we set. We have to figure out what our competition is charging. We have to figure out how we want to differentiate our product in the marketplace. What does that mean? If I was telling you just off the cuff, like, hey, I'm going to sell you a $5 cake versus a $100 cake, without knowing anything else about the cake, what would you say? What would you say is the higher quality cake?
The more expensive one?
Yeah, but you don't know. It could be the same cake, right? I'm just telling you the price. You're right, Saeed. But that's the thing is, just by changing the price, you expect a higher quality.
Yeah.
Like if you sold you a $100 book versus a $5 book, you'd expect the $100 book to be a higher quality, right? Even though, like, if I taught this class at Stanford or I taught it at Ohlone, just because it cost 100 times as much at Stanford, you'd expect a higher quality, even though I'm the same teacher, right? It's the exact same concept. So setting a price, you can set a price just for differentiating your product. Or by having a differentiated brand, you can charge a higher price. Product life cycles, same thing. I used to work for a big firm and I worked for a small firm. I used to be charged out at $500 an hour for a big firm. The small firm, I was at $200 an hour. I'm the same person, right? So it's this concept of differentiation. Yep. Christina?
Oh, so I was just thinking about the cake example from earlier, like the make versus buy the cake to then sell it, right? But if you were to make the cake yourself and then sell it as like, oh, baked on site, it's better, and you can charge more and make up the difference. I mean,
exactly. So I was just
like,
looking at cost, right? We're looking at cost in the last. Now we're going to look at the other side, price. So you're right. Like there could be situations, and they should always be looked together. So like if we could actually make the cake and then mark it up based on differentiating it through pricing, like then yeah, that should go into our decision, and we should just bake it on site. You're thinking about it correctly. That's why this stuff gets rather complex. And then like, how do you actually know that your customer is willing to pay a certain price until the customer actually pays? And so that's a bigger question that I think a lot of entrepreneurs struggle with, is like they think too much about it and they don't actually, like, what I'd recommend is do both. Like try to sell a cake and try to process it more, and try all these different strategies until you figure out what customers are actually what they want and what they're willing to pay. Does that make sense?
Yes. Thank you, Professor.
No, great thoughts. So product life cycles, also like products that expire quickly, you normally can sell for a cheaper price, rather than like, you're never going to spend, I don't know you. I mean, maybe you're a multimillionaire and then, you should donate to your teacher's fund, but if you're not, if you're like me, you're not going to spend $10,000 on a cake because you're going to eat it pretty quick. But you might spend $10,000 on a car because you might have it for 20 years, right? Like, so product life cycles also dictate price. Well, if you have a home for your life, it might be hundreds of thousands of dollars to millions of dollars. So some ways to determine price. I want to stress pricing is like a very complicated structure. These are just some traditional old ways of setting price. I wouldn't say make price based off of this nowadays. You just need to know them, that historically we've developed these theories. So cost plus is you take a cost and you add a markup. This is like the worst way to set pricing in the marketplace, but it's a way to do it, where you say, I know my cake cost me $2 to make, and I always want to make a 50% profit, so I'm going to charge $3. It's not the right way to do pricing. It's just a way. It's simple. You take your price, you figure out how much markup, you figure out your selling price. The next one is your total cost method, where you figure out your variable costs, you figure out your fixed costs. And then, so here they're figuring out their total cost per unit. We've already done that a lot throughout this class. And we did it through the departmental last class. And then we figure our markup and then we add it. So here's just the math behind it. What about a target cost? So let's say there's a lot of competition. We know that the market price for this old MP3 players, maybe phones, is $80. We want a $14 product price per unit. So we mark up our marketed percentage is 14%, $14 is 70 or 20%. So we always want $14 per unit. So we must reduce our total cost per unit to $66, because we want $80 minus our $14 profit, which gives us a total market percentage up. So once 14% return on invested assets, that means we get a $140,000 target profit. So that's $14 per unit. Again, this isn't used frequently. I don't like either of these. The target cost method and I don't like any of this. What I'll test you on is probably the cost plus, just because you have to know it. And then just know there's other ways to get to these methodologies. Another concept is a variable cost method, where you just take your target profit plus your fixed costs and divide them by your total variable costs. And then you add a markup to it. The added markup is here. So we're saying we want a $140,000 profit. We have $140,000 fixed overhead, and we have $60,000 in fixed selling and administrative expenses. And then our total variable costs are here, 44 plus 6 times 10,000. And this is just how the math plays out. The 50 plus 50 times 68% equals 84. That's our selling price. This is just like basic algebra. It's not going to go in any income statement or anything. So just know that you will have to know these equations. Everything's open note, right? So you can always reference back to these slides. There's other pricing methods like ads do auction-based pricing, where or sometimes housing lately has been a very auction-based pricing, where you have a lot of people come and they all give their best offers. You can also price based off value, where you could say, hey, I have a product that will guarantee you $1,000 in sales, so I'm going to sell it for $900. So you always are guaranteed $100 in sales. Or you can do dynamic pricing. This is what Amazon and a lot of stores got in trouble with during the pandemic. When there's a surge in pricing, like when toilet paper went up, everyone started selling toilet paper for a ton more. That's like a pretty bad practice. Companies get in trouble. But it's a way to make money too. So it's your decision, ethics versus money, I guess. And I guess it depends on like if it's a luxury good or not. If you're selling toilet paper and eggs, maybe you don't surge the pricing just because people need it. But if you're selling luxury watches, maybe it's not unethical.
Sir, but historically speaking, these bigger companies, they actually never get caught for editorial pricing. Like I read about Amazon and how they monitor who sells, like which product is the best selling, and then they'll order it from the manufacturer themselves and undercut the actual seller. And
No, no, you're right. So I wouldn't say never, but obviously these are used, and but they don't use it in such a way that become predatory. They kind of try to fly under the radar, right? Like maybe they add a 10% markup or a 20% markup, but they're not making it 10 times the cost or 20 times the cost, right?
All right, yeah.
That's what I'm trying. But yeah, obviously this is a pricing. You see it during winter, right? Like you might mark up things during winter, mark down things when things are slow, so on and so forth. These are just standard pricing things. I don't think it's the best practice. Personally, I don't think it's a great practice. I think you differentiate your product and keep it in the marketplace. But it's a way to kind of squeeze margins out of people, right? So the next piece is like from price. So that's like general pricing theory. My summary is, hey, it's more complicated than you think. There's some simple ways here to figure out a way to set your price so you don't set it lower than what your costs are. That's pretty much, but you shouldn't use that if you're making your own product. You should just have that as like one indicator of what your price might be. So what if you get a special offer? So this makes things even more complex. So let's say you have your cake in the marketplace, you're selling it for $20 a cake. Someone comes to you and says, hey, I want to buy a bunch of cakes for $10. Should you take it? Well, first thing is you might not want to, because you don't want to be known in the marketplace as a $10 cake. You've already decided you want your cakes to be priced at $20, and people find out that you're selling cakes for $10. The people paying $20 might get upset. That's the first thing. But let's say you can kind of hide that information and you can give someone a special discount if they order a bunch. So they're going to order 100,000 cakes at $10 a unit. What we do is create like kind of a financial statement to see if it actually is profitable at that price. Because at that price, you have a different volume of output. So here they're saying $10 per unit. Here's all the associated costs. We have direct materials, labor, overhead, and selling expenses of $2.40. Bring us down to a contribution margin of 240 cents. And then our fixed costs bring us down to $1 per unit. So since we're still making a profit, theoretically, we should accept it if we have the capacity to accept it. So all we're saying here is if we make a positive contribution margin, we should accept the product. Or if our operating income increases, we should accept the additional sales if we have the capacity to accept it. And this last slide is just about service pricing. So let's say you're a plumber or an accountant. This is just a way for you to price your accounting services. What's your rate per hour? What's your materials used each hour? And then what margin do you want to make on your services? I'm not going to test you too much on the service markup. Because again, I don't think that's how the market is really done. I think the market is based on value. Like, how much are my services actually cost? It's so arbitrary in accounting. Like, I just use a computer. I don't really have any costs associated with it, right? So unless you're running a firm, and then this is really dependent on, it's still more based on like what your competitors are charging and how you want to be differentiated in the marketplace. So you won't be tested on the time and materials pricing. I know everyone went over this quick, but it's because we're not like doing big statements or anything. It's really just big takeaway from this chapter is, do we have sunk costs? If we do, take them out of your decision making. Only use the relevant costs, and it's going to be based off each fact set. Again, I have to look at each fact set and decide: is this a relevant cost, or is this something I can't get out of? Like overhead is generally something you can't get out of, or rent expense for sharing a factory. So much more simple chapter based on the previous one. Let me know if you have any questions related to this. I went through this a bit quicker, but I was trying to be cognizant of that we spent a lot of time today crunching numbers. So any questions? Chapter 10. Thumbs up if you all are good. I'll stop sharing. I'll stop recording then. Let me see. Stop recording.